It's 2008, and the global financial system is falling apart. Banks are collapsing, markets are frozen, and millions of people are losing their homes almost overnight. Meanwhile, on Wall Street, things look very different. Bonuses are protected, bailouts are approved, and $700 billion are rushed out the door, paid by people who didn't break the system in the first place. Trust in banks evaporates. Faith in governments burns even faster. And what replaces it isn't hope, it's anger. Because when people lose trust in money, they don't just complain. They start looking for a way out. A few months later, on October 31st, 2008, an anonymous hacker using the name Satoshi Nakamoto quietly uploaded a 9-page PDF to the internet. There was no launch event, no venture capital, and no guy in a hoodie asking anyone to believe in his vision. Just an idea, dropped into the world with no face attached and no one to stop it if it spread. It asked a simple, dangerous question. What if money didn't need banks at all? The paper doesn't arrive with headlines or hype. It drifts into a small cryptography mailing list, a quiet corner of the internet where people don't talk about prices or profits, but about systems, incentives, and how things fail. So, who actually pays attention? Not traders staring at charts. Not investors hunting the next big win. This is a place where arguments last weeks, not minutes, and where ideas are pulled apart, line by line, usually by people trying to prove they won't work. Most of them just watched the financial system collapse. And instead of asking how to fix it, they kept asking a different question. What happens when trust fails? The paper doesn't promise returns. It doesn't ask anyone to believe. It asks something far more uncomfortable. What if money didn't require trust at all? And it doesn't leave that question hanging. The answer is mechanical. Replace trust with verification and authority with rules anyone can check. To most people, that sounds boring. Inside this group, it sounds dangerous. Because for the first time, money isn't protected by reputation or power. It's protected by math, and by people actively trying to break it. For now, that's all Bitcoin is. An idea quietly stress-tested by skeptics, while the rest of the world looks the other way. An idea is easy. Anyone can write a paper. Anyone can complain about a broken system. The real question is simpler and harder. When does an idea stop being a protest and start becoming a system? That line was crossed on January 3rd, 2009. Not with a launch event or a press conference, but with a single block going live, quietly and without permission, the Genesis block. Inside it wasn't a slogan or a mission statement, but a newspaper headline from that very week. Chancellor on brink of second bailout for banks. So ask yourself, why lock a headline inside code forever? Because this wasn't about money yet. It was about context, a timestamp saying, this is why this exists. From that moment on, Bitcoin didn't ask anyone to trust it. It didn't promise returns. And it didn't need its creator anymore. Every 10 minutes, the system asked a single question. Who's willing to spend real energy to keep this honest? No referees. No central authority. Just math, electricity, and incentives pulling in the same direction. And once that switch was flipped, something changed. Anyone could join. Anyone could verify. No one, not even the creator, could rewrite the past. At that point, this stopped being an experiment. So the real question isn't whether Bitcoin was a good idea. It's far more unsettling than that. What happens when money runs without anyone in charge? A system can exist on paper, and it can even run quietly in the background for a while. But sooner or later, it has to face a much harder test, whether anyone is willing to use it for something real. For months, Bitcoin didn't buy houses or stocks, or even a cup of coffee. It moved between computers as an experiment, mostly proving that the rules worked. Then, in May 2010, someone decided to try something reckless. A programmer named Laszlo Hanyecz made a simple post online, offering 10,000 Bitcoins for 2 pizzas. Not as a joke, not as a statement, just a way to see if this thing could actually buy dinner. At the time, those coins were worth almost nothing. There were no headlines, No debates about the future of money, just one quiet question hiding in plain sight. Would anyone accept this? Someone did. 2 pizzas showed up at Laszlo's door. For the people watching, it didn't feel historic. It felt almost stupid, spending something new on something forgettable. And with that delivery, Bitcoin crossed a line it could never step back over. For the first time, this system didn't just exist. It settled a real transaction between 2 strangers, without permission, without a bank, and without either side having to trust the other. And that's what mattered. Not the pizzas, not the price, not the future value, even though those same 2 pizzas would later be worth over $600 million. What mattered was the proof. Proof that a system with no company, no government, and no owner could still move value cleanly from one person to another. And once something works in the real world, even in the smallest way, people stop asking whether it matters. They start asking something else, entirely. How far can this go? At first, Bitcoin wasn't about price. It was about proof. Proof that the system worked. But once something works, a different question always follows. Not how it works, but what it's worth. In the beginning, the answer barely mattered. Coins traded for cents, sometimes less, passed around by people who were curious, not confident. Then the numbers started to move, slowly at first, over the next few years, not dramatically, and not overnight, but just enough to be noticed. Small price changes were enough to turn a quiet experiment into something thousands of people began watching. And when price enters the room, everything changes. Because price does what ideas never can, it turns curiosity into temptation. Suddenly, Bitcoin wasn't just a system running in the background. It was a chart on a screen, a number ticking up and down, a signal people couldn't stop checking. People who didn't care about cryptography started paying attention. People who ignored it the first time began asking new questions. Not about technology, but about timing. What if I'm early? What if this keeps going? What if ignoring this is the real mistake? Price didn't prove Bitcoin was valuable. It suggested that other people might believe it was. And that suggestion was enough, because once money has a price, it stops being neutral. It starts pulling on human instincts, fear, greed, regret, and hope, all at the same time. The conversation shifted, not from system to system, but from how it works to how much it might be worth. And that's the moment the story changes. Bitcoin didn't become dangerous when it was invented. It became dangerous when people started watching the price. Because systems run on rules. But markets run on people. And people don't behave like math. Once Bitcoin proved it could move value, the question quietly shifted. Not can it work, but why are people starting to care? Because belief doesn't spread through code or white papers. It spreads through stories. In the early 2010 seconds, those stories didn't come from headlines or institutions. They lived on obscure forums and mailing lists, in places like Bitcoin Talk, where by 2011, tens of thousands of users were already arguing, testing, and watching this thing unfold in real time. Someone bought pizza. Someone else tried sending money across borders. Someone lost their keys and discovered the rules didn't care. None of these moments proved Bitcoin was the future. But together, they did something more powerful. They made it real. Stories don't need understanding to travel. You don't have to know how a system works to remember what it did. And once Bitcoin became something people could describe, not just something developers could explain, it stopped being abstract. People stopped arguing about blocks and hashes and started arguing about outcomes. If it worked for them, why wouldn't it work for me? Belief didn't arrive all at once. It accumulated slowly, unevenly, through repetition, one story, one example, one mistake at a time. And with each story told, Bitcoin gained something it still didn't have from banks or governments. Not approval, but momentum. Because systems don't change the world on their own. People do. And once enough people believe a system is worth paying attention to, the system doesn't need to persuade anyone anymore. The story does that for it. For years, Bitcoin lived comfortably outside the room, ignored by banks, dismissed by regulators, and laughed off as a toy that serious institutions didn't need to worry about. That was easy. because ignoring it cost nothing. But by the mid-2010 seconds, Bitcoin developed an inconvenient habit. It kept surviving. It crashed, recovered, and kept running, block after block, while critics kept explaining why it shouldn't. By 2017, the tone shifted. Publicly, executives like Jamie Dimon, the CEO of JP Morgan, were calling Bitcoin a fraud, confident that saying it out loud would close the case. For a moment, it looked familiar, the system doing what it always does, ridiculing something new until it disappears. Even Warren Buffett, echoed by Charlie Munger, dismissed it as worthless, the kind of verdict that usually ends a story, unless the story refuses to end. And this time, it didn't. Behind closed doors, behavior told a different story. Banks weren't adopting Bitcoin, but they were hiring researchers, forming internal crypto teams, and quietly preparing for a scenario they refused to acknowledge in public. What if this thing didn't go away? Bitcoin wasn't dangerous because it was large. It was dangerous because it was persistent. Every attempt to dismiss it collided with the same uncomfortable fact. The network kept settling transactions, without permission, without pause, and without caring who disapproved. This is the moment most people miss. Institutions don't react to ideas, and they don't panic over ideology. They react to systems that survive long enough to become unavoidable. Bitcoin had crossed that line, not into acceptance and not into trust, but into something far more serious: attention. It wasn't embraced. It wasn't legitimized. It was being watched carefully. Because once power starts watching, the question is no longer whether something matters, it's how much risk ignoring it creates. And when risk enters the room, the story changes again. Once institutions started paying attention, the next reaction was predictable. The loudest voices didn't come from engineers or regulators, but from people who already owned the old system. By the late 2010 seconds, criticism stopped sounding casual and started sounding personal. In 2018, Warren Buffett didn't bother with nuance. He called Bitcoin rat poison squared, dismissing it as something with no value, no productivity, and no future. His longtime partner Charlie Munger went further, calling it disgusting and contrary to the interests of civilization itself. To them, Bitcoin wasn't innovation, it was an insult. And the logic was simple. Bitcoin doesn't produce cash flow. It doesn't generate rent. It doesn't build factories or grow crops. In a world built around assets that yield something, Bitcoin looked like an empty shell, something people traded, but nothing that actually worked. Even banks joined the chorus. In 2017, Jamie Dimon publicly labeled Bitcoin a fraud, warning that anyone buying it was asking for trouble. At the time, that wasn't a controversial position. It was the safe one. From the outside, it looked decisive. Powerful people with decades of experience explaining exactly why this thing was worthless. But criticism has a strange side effect. It forces a comparison. Because while Bitcoin was being mocked for producing nothing, it was still settling transactions. While it was being called useless, it was still moving value across borders, still operating without bailouts, and still running on the same rules, block after block. The critics were judging Bitcoin by the standards of the system they understood. And by those standards, they weren't wrong. Bitcoin wasn't trying to be a company. It wasn't trying to be a business. It was trying to be something older, an asset designed to exist without permission, without yield, and without anyone in charge. And that's why the criticism mattered. Because when the most powerful investors in the world all agree that something is worthless, and it refuses to disappear anyway, the question quietly shifts. Not, is this stupid? But why is it still here? And once that question enters the room, the story stops being about opinions and starts becoming about consequences. When markets argue and critics shout, governments usually stay quiet. They watch first, because stepping in too early means admitting that something actually matters. But by the early 2020 seconds, Bitcoin had crossed a line that made silence impossible. It wasn't just being talked about anymore. It was being used, at scale, in ways no one had officially approved. In 2021, China made its move. Mining operations were shut down almost overnight. Exchanges were pushed out. What had once been tolerated was suddenly declared unacceptable. The message was unmistakable. Systems that move value without permission aren't neutral. They're political. For a moment, it looked like a kill shot. China controlled a massive share of global mining, and if Bitcoin depended on power, this should have broken it. It didn't. Miners packed up and moved. The network slowed, adjusted, and kept producing blocks, not because anyone allowed it to, but because the rules demanded it. And that was unsettling. You can ban companies, you can regulate people, but trying to ban a system that reroutes itself is a very different problem. That same year, El Salvador sent the opposite signal. In 2021, it became the first country to make Bitcoin legal tender, forcing every government watching to confront an uncomfortable reality. This system wasn't just resisting states. Some states were choosing to use it. In the United States and Europe, the response fractured. Some officials argued for outright bans. Others pushed for regulation. Hearings were held, definitions were debated, and the same question kept resurfacing in different forms. What exactly is Bitcoin? And who is supposed to control it? That question has no clean answer. Bitcoin doesn't live in one country. It doesn't have an office to raid or an executive to subpoena. It exists wherever the internet exists. And it obeys rules written years earlier by someone who never stayed to explain them. This is the moment the story changes. Because once governments step in, the issue is no longer innovation or speculation. It's sovereignty. Who gets to decide what money is? Who controls how value moves? And what happens when a system ignores borders the same way it ignores opinions? Bitcoin didn't win this confrontation. It didn't lose it either. What it did was survive the most serious challenge possible. Not ridicule, not criticism, but state power itself. And once a system proves it can endure that, the conversation can never return to whether it matters, only to what happens next. After crashes, bans, ridicule, and regulation, one uncomfortable fact remains. Bitcoin is still here. Not because it won every battle, or convinced everyone, or was protected by anyone powerful. It's still here because it was built to survive the moments when protection disappears. Most systems are designed to work when things go right. They depend on trust, authority, and someone stepping in when something breaks. Bitcoin was designed for the opposite moment. When trust collapses, authority fails, and no one agrees on what to do next. That's the real difference. Not speed, not price, not even technology. Its real superpower is that it doesn't need permission to keep running. Every time it was declared dead, the system kept settling transactions. Every time it was banned somewhere, it adjusted and continued somewhere else. And every time critics explained why it shouldn't work, it quietly did. Bitcoin never promised stability, fairness, or profit. What it promised, without ever saying so, was persistence. And persistence changes the conversation. Because once a system proves it can survive crashes, survive bans, and survive being hated by the people in charge, the question is no longer whether it works. The question becomes what it means. What does it mean for money to exist without borders, for value to move without permission, and for a system to refuse to disappear no matter who wants it gone? Bitcoin doesn't answer those questions. It forces everyone else to, and that may be the most disruptive thing of all.